Hello everyone, my name is Prajesh Shrestha. I'm the Managing Director of Kingsgate Finance. After Bank of England decided to increase the interest rate from 4.5% to 5%, we recognized we needed to create this video to help you, our clients, in understanding how the interest rate change will impact you. So firstly, why are interest rates going up? The obvious answer we all know is because of the high inflation. So how is inflation going up? So we believe it's because of two main reasons. Firstly, the war in Russia, which is causing energy crisis, which we cannot do anything about at the moment. And secondly, the tight labor market due to rising wages and salaries. This is a bit of a controversial topic, but what ex-Chancellor Philip Hammond said was absolutely thought-provoking. He said we need to soften the labor market. In the days when we're in a single market, that is when we were still in EU, this would have happened automatically. More cheap labor would have come in, attracted by higher wages rates here in the UK, but this has not happened now. Rather, government has regarded any relaxation of migration rule as being politically toxic. So this is something to think about, and I urge you to go and listen to Philip Hammond's interview. So how are Bank of England are planning to manage the inflation? So one of the tools, or the only tools that the Bank of England has to manage the inflation or to bring the inflation down, is to increase interest rate. So this could actually potentially dampen the whole economy by reducing economic activity, slowing economic growth, potentially even leading to recession. However, the idea is that the higher interest rate should discourage borrowing and encourage saving. By doing this, they're trying to take money out of the economy by making borrowing more expensive so that people have less disposable income. And Bank of England is actually doing this deliberately, not to make people struggle, but because this is the only option that they have at the moment. As Martin Lewis said, this is not accidental, nor coincidental, or byproduct, but it is direct policy to squeeze income for those who have borrowings. So now you might be wondering, what are you talking about, Raj? So we have all heard that inflation has come down from 10.1% to 8.7%. Yes, that is true. Inflation has indeed come down to 8.7%. So then I questioned myself, why on earth the interest rates are going up? Then I found out the inflation that everyone's talking about is the headline inflation, which has indeed come down from 10.1% to 8.7%. The reason why the interest rates are going up is because the core inflation spiked from 6.8% to 7.1%, which is the highest level since March 1992. So now you might be wondering, what is core inflation? So core inflation is inflation related to all commodities, goods and services in the economy, excluding food and fuel prices, which are deemed to be more volatile. So the rise in core inflation is actually causing turmoil in the lending market, which is actually leading lenders to withdraw the products due to heightened uncertainty. This is not due to lenders' unwillingness to lend, but rather due to increase in the swap rate. So now I understand that I might be throwing in a few financial jargons here, but I strongly feel this will help you in the future to follow news better. So what are swap rates? Swap rates reflect market's expectation of the future direction of Bank of England's base rate. So they are based on assumption about the interest rate over the swap rate terms, such as like 2 years or 5 years. So lenders use swap rates to set borrowing prices. But by the way, this only affects the fixed rate mortgages. So higher swap rates will result in higher mortgage rates before risk and lending is considered. So what are the consequences or what are we likely to see with the rising interest rates? So they actually had the Conservative actually had a manifesto pledging to continue to increase the number of homes being built, and their target was to build 300 homes per year. However, the supply only reached 247,000 in 2019-2020, and even that it has since fallen. So with the rising interest rates, developers are actually struggling, leading to less supply of the property in the market, and especially in London, where the construction has fallen by 50%. And high borrowing cost will set to squeeze homeowners and property investors, leading to more buy-to-let investors exiting the market, consequently higher rents due to decreasing supply of the property. So renters in the high demand areas such as like London are already spending 40 to 50% of their salary on rent. So does that mean the property prices are going to go down? Most likely not. The increase in cost has actually impacted property prices, but analysts still predict that 3 to 4% annual property price rise, which are still we are still expecting more renters than owners due to the increase in interest rate affecting the mortgage affordability. So apart from the doom and gloom, what does the future look like ahead of us? A rise in interest rate does not necessarily mean or does not really correlate with the rent increase, but rather with demand in the area. So the renters, what I would say is that if you can buy the property, or if you can't buy, then maybe move into the area where there is a less demand of rent. So if you're in central London, maybe move outskirts of London. And also, it's good to buy. It is actually a good market for the first-time buyers, because it's paying 5% or 6% is better than paying your landlord's mortgage, which is like paying 100% interest. The money that you paid the landlord is never coming back, so it acts as like 100% interest, £1,300-1,400 that you pay. And again, the renters, we still have a couple of options for you. We have options like income boost mortgages, deposit boost mortgages, and 0% deposit mortgages also available for you. So please get in touch. Additionally, so in the economy itself, the wholesale energy prices have fallen, but we might not have yet felt the impact. But however, these changes will help to bring the inflation down. And there's also been a sharp fall in prices of imported goods and businesses that rely on production, and the production are starting to feel some form of relief. And people already have less money to spend, which means that there is less demand of goods and services in the UK. So that should also help to bring the inflation down. So struggling landlords, what should you do? So I would say check finances, get back to the drawing board, sit down and start crunching numbers. Dispose any poorly performing buy-to-let properties which are unviable, and take full advantage of low fixed rates. Lenders are becoming more creative with their interest rates. So if you'd like to find out more, please get in touch. So for residential owners who are currently on a fixed rate, if you have a fixed rate, your rate is secured until it comes to an end. However, if your rate is due to come to an end, even by the end of this year, we highly advise you to speak to your mortgage advisor. Many people aren't aware that they can secure the rate 6 months in advance. By doing so, if the rate goes up, you have secured the rate. But if it goes down, you are allowed to switch to the newer rate, which is the lower rate. Therefore, the sooner you secure a rate, the better. It's a win-win situation. However, for variable rates, you should have received a letter from your bank informing what your new monthly mortgage payment would look like, and which will obviously be in line with Bank of England's rate. And if you're on a variable rate, we would like to advise you to speak to your mortgage advisor, because the variable rate might not be the best option for you at the moment. We normally advise our clients based on their circumstances and their risk appetite. So if you'd like to get in touch with us, please do so. And if you are struggling to pay your monthly mortgage payment, please get in touch with your banks directly, or you can even contact us. We might be able to help you navigate through the available options. I hope that was helpful. If you have any questions regarding mortgages, please get in touch. Our number is 0333 090 1616. Thank you. The content in this video is provided for informational purposes only and is based on available information at the time of creation. It is neither an offer nor a solicitation, and it does not constitute financial tax or legal advice. The content does not take into account your individual financial circumstances and objectives and may not be suitable for your specific needs.